this is a deal nobody really liked from the start. Rite Aid and Albertsons say they mutually agreed to abandon their $24 billion deal announced back in February. Rite Aid already down nearly 12% this year because of shareholders just never really buying in. Our CNBC.com colleague Lauren Hirsch notes that top 10 Rite Aid holder Highfields Capital opposed the deal. The shareholder advisory services did as well, arguing that the deal undervalued the pharmacy chain. Albertsons, which is privately held by Cerberus Capital, said it was not willing to boost its offer. Because they mutually agreed to part, there will be no breakup fee. Now, Rite Aid chairman and CEO John Stanley telling shareholders, while we believe in the merits of the combination with Albertsons, we have heard our stockholders and are committed to moving forward now as a standalone company. Rite Aid has a much smaller footprint after selling 2,000 stores to Walgreens after that deal failed. The key now will be whether it sells off its pharmacy benefit unit Envision RX. And guys, you know, this comes one day after, just hours after Carl Icahn raised an objection to the Cigna Express Scripts deal. The investor services should be out with their notices tomorrow. It'll be interesting to see if they come out against that deal, what the implications are there.
What do they think were the merits of the deal? Why did they try to get together in the first place? This vertical integration?
Well, essentially, you know, Rite Aid was left a shell of itself after the Justice Department said they couldn't merge with Walgreens. And so what they thought is that they could leverage the Envision RX PBM, which is now a business that's the prescription benefits manager, which is now a business that is under more scrutiny, and use their pharmacies, put them in Albertsons, and be able to have sort of a bigger footprint with Albertsons. For the PE folks who own Albertsons, that gives them something a little stronger as they try to spin that out as an IPO.
Got it.
Now it sort of makes it unsure for both in terms of their path.
Do I understand correctly, though, in terms of the chronology, maybe when the deal was proposed, the PBMs were not quite as under intense pressure,
not quite
and
as
the
under
regulatory
pressure.
and the
but
oversight changed in the meantime?
Right, but this is really more about the cash. The people felt that they didn't give them as much cash. The interesting things on the PBM is that the two biggest yesterday came out and said, hey, we are not collecting as much of those rebates, those confidential discounts that they get from drug makers.
Key for them.
We had Express Scripts saying that we only get $400 million in revenue from that, so it's not a big revenue stream for us. And you had yesterday CVS say we now only get $300 million in revenue. That's only 3% of our revenue. We're giving back 98% of those rebates to our clients, and we're actually telling them that they should give the rebates at point of sale to people who are still in the high deductible phase. So they are trying to diffuse and get out ahead of that issue.
Sounds like it's bolstering Carl's case, Icahn's case.
Yeah. No, this is the idea of it being a folly, the price being a folly. The question is, can you do better just as a partner?
Well, but it's also difficult. I mean, he also suggested that they build their own PBM the way Anthem is, but that's a long-term process, and they would be far behind trying to do that. So that's one of the things that David Cordani sort of said, you know, that wouldn't be something I could really do when he talked yesterday on Squawk on the Street.